Hey, everybody, and welcome back to another episode. Today, I've got Melissa Nash on the show. She has 12 plus years of real estate investing. She's built a portfolio of over $7 million in real estate assets. That's a mix between short term rentals, long term rentals. We're going to talk about pivoting and kind of going back and forth with that kind of stuff today and what's happening. She's helped over 2,000 investors purchase rental properties. Interesting fact. And she's guided investors through more than 500 million, y'all. That's $500 million in real estate transactions. She's done over 50 plus renovations. She's got experience with long-term, short-term, BRR, build to rent, 1031 exchanges, creative financing, you name it. And she's built a portfolio while raising 4 children. Y'all going to listen to this today. We're going to have a great conversation. Melissa, welcome to the show.
Hey there. Thank you so much for having me. I literally needed to hear that bio sometimes. It's easy to kind of forget where you've come from and how much you've accomplished. So please read that to me every morning. I think I need that.
With the same enthusiasm, right? Just record it and send it to you so you can hit it. We'll just make that your alarm clock when you wake up in the morning.
Exactly, exactly. It was your enthusiasm that really made it for me. So thank you.
Yeah. So you have been investing for 12 years and you are having a lot of success with a specific type of strategy to acquire rentals. And we'd kind of talked this a little bit before the show. I had mentioned that, I'm part of some networks and groups, and a lot of people I know are coaching on like wholesaling, house flipping, single family rentals. That's by far the biggest total addressable market of like things that people want to learn. And from my point of view, what I was hearing was people were getting wrecked. Debt to service coverage ratios, like, the mortgage, the rent can't even pay the mortgage because interest rates are so high. Houses are just sitting on the market. Rents are getting compressed. Like I'm hearing it's kind of been like a bloodbath, but you've got a strategy that is actually working right now. So I want to talk about that a little bit. But before we get into it, so what's your story and how did you get into this whole game of real estate and investing?
Yeah, so I'll kind of give you the fast forward version of it. My husband and I owned our own business. We were entrepreneurs, and 2008 happened, and we were wholesaling clothing, actually, importing it from overseas, and we were selling to little boutique stores, and they just started closing down one by one, and we just saw the writing on the wall, and we had to exit that business very, very quickly. And then we sat there. We had a little bit of money from the sale of it and just kind of going, ugh, what's next? Like we had built our life around this business and it wasn't recession proof because we hit the recession. And I was like, we need to have a recession proof business that doesn't require us to carry inventory and for us to be paying for goods in advance. That we was a very cash poor business. And so I was like on the hunt, and I had always been obsessed with real estate. And I'm in California. And so I was like, I'm going to get my real estate license. I'm going to learn everything about real estate investing. No, you don't
Huh.
learn anything about real estate investing becoming a real estate agent. You learn how to be a tour guide and you learn how to, walk agents through or walk buyers through a contract. I mean, that's about it. And so I was as a new agent and I was kind of like looking for something bigger and I wanted to do something like substantial with my life. I knew rich people owned real estate. That's like all I knew, rich dad, poor dad, all the things. And so I was in that journey and I started looking at the agents who were successful. And then I was like, well, what are their clients doing? And how are people buying these $1 million properties? And, so I was kind of on that hunt and that search. And I got really defeated because I was like, I live in California. Like, I didn't even know what landlord friendly was at the time. California's not landlord friendly. I didn't even know about that. I was just looking at the
Yeah.
numbers and I was like, I can't buy at the time, now they're a lot more expensive, but I was like a six, $700,000 rental property that rents for like 1,200 bucks a month. I was like, that makes no sense. I don't have the money to buy these, apartment complexes. And I was like, I guess that's it. I guess I can't invest. Like game over, and I'm sure so many of your listeners can relate to that. If you live in an expensive market, you think that you can't do it. And so I went on a hunt and I was like, wait a minute, I used to live in the South. My husband and I lived there for a few years. Our first daughter was actually born in Georgia. Well, actually, she was born in Washington, then we moved to Georgia. Anyways, um, and I was like, houses are so much more affordable there. We bought our first house there and it was so cheap. And I was like, I wonder if I can buy real estate in another state. So that's really where that beginning journey kind of started.
Interesting. And so you've coached over 2,000 students to help them acquire their properties, and you've got this really interesting this strategy for acquiring rentals that is actually working in this economy. And so like that's the main thing here. I want to hear like what is this strategy that's working? How are you acquiring rentals when interest rates are at all-time highs and it's just not been that great of a market for it?
Yeah. Well, I'll tell you what the strategy is, and I'll kind of tell you something funny about that too. Is so since I've been helping clients for the last 10 years, I help them buy properties that are already renovated. So they're not hiring contractors, they're not doing the work. The properties are technically called, there's a term people throw around a lot. It's called turnkey real estate investing. And the word has either good or bad connotations depending on what their experience was or how much is involved. I've made that program into what I call my lazy investor strategy. And I've detailed it very, very specifically in steps on how you can be successful buying a property out of state that's already renovated with a local property manager in place and with all the teams there. So you don't have to do anything. Like the lenders are there, the title's there, escrow's there, the insurance companies are there. Like everything is done for you. And then I pre-vet the properties and I only work with teams that have passed my vetted system. And some of the teams that I work with, I've known for over 10 years and have helped clients buy with them. So I know their rehab quality, I know their warranties. I know how they stand behind clients after closing and they're not just going to disappear. I know that they want to earn my clients' business to continue to buy properties. The property management piece is the most important piece because there's a lot of property management companies out there that are for profit and just want to nickel and dime you to death. So we have to have a good property manager that has really good communication and really wants to help you succeed as an investor. So when I put together all these things and all these people and all these systems, it's not just me like guessing and going, "Hey, that looks like a good property manager on, on Google." Like, no, I actually have, you know, hundreds of clients with them and I've seen the back end. So I've seen the communications after closing. So the before, the middle, and the after. So it really is about people. So it's about getting access to these properties, which are off market. So if you tried to do it yourself, you're going to have to go out and find the market, find the team, trust that you did it right, vet it all out yourself, check the numbers, find, you have to do a lot of work. So I've already done it. And so the interesting thing about it, since you said with interest rates and all the things. So one of the markets that I love and I've been helping investors buy in for the last 10 years is Indianapolis, the Midwest. It's a very steady Eddie, boring market. We're not expecting, overnight appreciation. We're not expecting get rich. This is a strategy. It's a buy and hold strategy that you hold long term. That's kind of the goal. And so I've been telling people for the last 10 years, average cash on cash return year one in Indianapolis is 10%. It's still 10% today. It was 10% 10 years ago. It was 10% 5 years ago, and it's still 10% today. And the reason why is even though, yes, interest rates have changed, the reason why is because in a market like the Midwest that appreciates on average in decent areas 4 to 6%, we also have rental increases happening around 3 to 4%. So if we just kind of round that out and just say 4% appreciation, and it's actually probably closer to 4% rental increases with the team that I work with, it's growing at the same time. We're like seeing that growth there. And so it has nothing to do with what I don't even think about interest rates. I don't even care about interest rates. I put them in the spreadsheet but I've also negotiated with the teams that I work with to help investors buy down the interest rate so that we can get the interest rate a little bit lower. And so the returns are the same and they're great. So you can literally go to Indianapolis. A lot of my clients who are in a program that I call the Deal Bank, get access to these off-market properties that I've already vetted out, and you could literally hand pick. It's like shopping. You're like, okay, I want this market or I want this return, and they can literally go in there and go, great, I want it. It's yours.
Interesting. So it's a turnkey model. And with these turnkey models, how are you getting, are the investors just buying them all cash with their own money and that's how they're getting the 10%? Or is it a down payment plus the debt financing?
20% down. The lenders that I work with will do DSCR loans all day long. Every single property that I have, at any given time, I have 30 to 50 properties that are newly renovated off market. You can only get them through me. It's what I've built out. It's the honeypot. Yeah, and every single property qualifies for a DSCR loan. The numbers are there. So you just go, okay, I want a $150,000 property. I'm going to put 20% down. I want double digit returns. There you go. I've got it.
So, okay. So they're putting money down. What's the average price point in rents of these properties? I'm just kind of curious.
Yeah, so it depends on the market, but since we're talking about the some of the, I love the Midwest and I love the South. I've got a team in like we're talking about like Birmingham, Memphis, Little Rock, Indianapolis, St. Louis. But
These are
just for
like
an
sub $200,000 homes.
Oh yeah. Oh yeah, for sure. Like here's a property in St. Louis that I've got in my inventory. It's $150,000. This one, the property manager, I've negotiated a lot of incentives, buying down the interest rate, free property management for the first year. Year one, the cash on cash return is 16%.
So they're earning 16% on the down payment that they put down on their money.
Yep, exactly.
And
So if they put down about $35,000, their return is almost 16%. Like where else are you going to get that?
now, how's the cash flow work for that? So for this specific property, us look at the numbers. So they're going to put down $35,000. How much are the rents coming in? And
1450.
okay, so 1450 times 12 gives you an annual rent. And so when you're calculating the cash on cash of being 16%, is that after you've got the mortgage paid and like all the expenses of the property? What go after the mortgage, what expenses are you factoring in there before that free cash flow is producing that 16%?
Yeah. So one of the really cool things and a big hot tip I'll tell people if they're ever looking at a property that's newly renovated or new construction, you need to use a pro forma that is for that model. Because I've seen so many people that try to use these pro formas for, somebody that's flipping or somebody that's like, buying distressed properties. And these are newly renovated properties. Like all the major mechanicals have been updated with warranties. So you don't need capital expenditures in there, especially if they just put on a new 30-year roof. Like, you know what I mean? So the first things that I include on the spreadsheet are we need to do the mortgage. There's four things you have to pay every single month: the mortgage, the taxes, the insurance, and your property manager. So we want to make sure that those are included. We also need to look at the warranties and go, okay, like, is it on these major mechanicals, usually they have, factory warranties up to 10 years, 5 years. We're kind of looking at that stuff. And then also, I don't know if a lot of people realize this, but you can buy home warranties years later after you close. In fact, hot tip, I have a house that always has random plumbing issues outside of the house, like going out to the septic system. It just always there's always an issue. There's always a clog. There's always something. And so every single year I buy a home warranty for the septic system on that property. And it's like $80 a year or something. And I just have it on renewal. And so 2, 3 times a year, I get a call from the property manager. They're like, hey, we're reaching out to the warranty company because there's a clog again. And I'm like, surprise, surprise. So things like that, there are strategies there to keep these as passive as possible and as cheap as possible to save you money. But going back to your question, we want to make sure that year one, we are including all of those things. Now, because a lot of the teams that I work with will do rental guarantees, they do warranties, your first year should be pretty darn good. There really shouldn't be any surprise expenses. Although you never know with real estate, always have money set aside, always be prepared for that rainy day. But yeah, so when I say year one, I'm actually talking about taking those deductions, and this property cash flows. Um, $460 a month. Pretty awesome after all those expenses are taken out.
Yeah, so the biggest issue I've heard with turnkey, and I think there's just lack of education in that community, is like I've had buddies by turnkey. It was funny. I think one of them might have been in the St. Louis market, and they think that they're buying something that is perfect, nothing's ever going to go wrong, and then something happens and the HVAC goes out of because the tenant has it turned up to 90 or 60 degrees in the middle of the 100-degree heat, and it's like, the evaporator coil freezes up and stops working, and they're like, what, I thought this was turnkey, this was supposed to be passive income, passive real estate. Can you speak to that a little bit? Because the turnkey, they're not 100% passive. I think very few real estate investments really are.
That's, oh my gosh, like I want to like literally write this in stone. This is the most important thing. Setting expectations. Honestly, I feel like that's usually what I'm doing with people. I am very straight up and honest. I've been doing this for a long time. I've helped so many people do this, and I hear the back end, and I know who the successful investors are and the investors who give up after just a couple of years. And it's setting expectations. If you go into this is not a get rich thing. Like I said before, this is a long-term buy and hold. It is a
Mhm.
commitment. And when you're focused on just the cash flow, you're not getting the whole picture. There will be a vacancy. There will be a maintenance call. You have tenants living in the house. You have wear and tear. I actually just randomly got a message from one of my property managers today, and they're like, "Hey, there's bullet holes in the roof. There's a leak." And I'm like, "What? Bullet holes? Like, is the tenant shooting up the house?" Like, I'm freaking out. And this is a
Yeah.
nice house in a nice area. And I'm just like, what is going on? And by the way, if the tenant did that, they should pay for it, not me. And so they came back and they said over 4th of July, somebody in the neighborhood was shooting guns up in the air. How scary is that? And the bullets came down on my roof. So it wasn't the tenant, it was somebody getting crazy at a party. That's random. I'm also not going to file a insurance claim on it because the repairs are like 200 or 300 bucks. It's not a horrific story. It's an easy fix. But anyways, that's just to show that like random things can happen and they will happen. So people need to expect that. But you also need to look at all the other things that are happening. So yeah, it's kind of a bummer. I'm going to have to pay for that. And I'm going to be, minus cash flow that month, maybe. But also, guess what? The tenant is paying down my mortgage every single month. The property is going up in value. I'm getting amazing tax write-offs. There's so many things. My money is being protected. Hedging inflation. There's so many things that are in the bigger picture that people forget. So
Mhm.
my job and my role is to help people focus on what their long-term goals are and how these properties can get them there, but then also what are the short-term risks? And if somebody is really, really risk adverse, that's the first thing we talk about is what are you afraid of? Is it property management? Is it expenses? Is it this? Is it that? And then we can pivot and we can go, all right, we're going to look at new construction for you. Or, hey, we're going to go to this market for you because it has a little bit more appreciation. Or, everybody has different, assumptions and fears and worries. And that's my job and that's my role is to work with them to figure out what is the best fit for them versus forcing a market on somebody. Like I would never tell you, "Oh, you have to invest in St. Louis." I know nothing about your investing style. I know nothing about your risks or, what you need or what you're trying to do long term. So that's the important piece is trying to figure out what the investor's goals are first.
Interesting. I like that approach, and I feel you because we peak season we were building 30 plus new homes per year, and when we got into building, one of the things that we didn't quite foresee when we originally had started 6 years ago was the warranty work. So we have our own construction company, and we build all the houses through that license. Well, in Tennessee, you have to warranty them for a year, which is great. Great law. I believe in it. You should do that. And when you're building these things, you care, right? You're building something that you're excited that the in-person and user is going to live in and grow and raise a family. And then you realize every single home, and I was talking with a lot of my builder buddies that have been doing it way longer than me. They're like, oh, yeah, every home, every single home that you build is going to have some kind of thing go wrong in a year. Could be something really small, could be something really big. Like we realized that some of the contractors on uh on one of the houses that didn't put like the waterproofing on the shower tray, and it literally was like like just imagine turning your freaking shower on and it just leaking into the living room. I'm like, what in the world? So when you have human beings build a home, there's going to be flaws. When you have human beings renovate a home, there's going to be flaws, right? We haven't gotten to the point where robots are perfectly, creating homes or renovating houses yet. I'm excited for that comes, but that's just the reality of real estate. You're going to have it's your landlord. I still have some homeowners 5 years. It's been 5 years, and they're like, "Hey, are you going to come fix this thing in my house? This little thing broke," and I'm like, "No, like it was 5 years ago. Like I'm not warranting your house for the rest of your life. Like you're gonna have home maintenance. That's part of being a welcome to being a homeowner now, right? But people just don't understand that. Why do you think that is?
Yeah, I think people really get sold on the whole. I mean, just investors out there is the passive lifestyle, the gurus with Ferraris, and and my clientele are busy working professionals. They don't want to be wholesalers. They don't want to go do rehabs. They're trying to free up their time. And so I always tell people like, yes, this is the most passive model other than maybe syndication. Syndications are pretty darn passive. Um, but to be 100% owner in real estate, this is the most passive option. However, the only way that you can make it passive is you have to buy in the right market, you have to buy with the right team, and you have to, again, setting your expectations correctly. And then also the property manager. One thing that happened to me, actually, my very, very, very first property that I ever bought, I'm not even joking that now I'm 2,000 miles away. I like literally sent in my wire, like our savings, and I was scared to death. I was like, "Oh my gosh, is this going to work? This is crazy." Like I just went for it and kind of did it. And right after closing, the property manager's like, "Hey, yeah, we went over to check on the house and there's a squatter there." And the squatter stole all the copper. And I was like, now this is the point where I'm almost grateful that this happened so early on and it was the first thing, because a lot of investors go, "Oh my gosh, this is terrible. I can't do this. I'm not going to be an investor. I'm out." But the way that it all unfolded is by the time my property manager called me, she had already solved the problem. She was like, "We found a squatter. We called the police. He's been removed. They stole the copper. Oh, and by the way, here's the bill." It was like $2,000 or something. And yeah, that sucked. But she solved the problems for me. I didn't have to do anything. That's what makes it passive, is having the right people and the right team. So all it was she called me, I answered the phone, and I approved it. And I knew she had it taken care of, and I knew she had my back, and it was already done. So in reality, it still is passive for me. My only job is every month to go through the property managers. They send you the bank statements, they do all the bookkeeping for you. And I just have to make sure that the rents came through. And, that's about it, or approve a work order here and there. So I'm talking not even with my portfolio today with short-term rentals. I mean, my long-term rentals, I don't even spend more than 20 minutes a month on my long-term rentals. My short-term rentals, I probably spend a couple hours a week.
Wow, that's fantastic. So how has the dynamic shifted between like the long term and short term? um because both are really good. I know that the Airbnb market has kind of popped here in Nashville. At least they built way too many of them, and that bubble kind of popped a little bit. How when should an investor, if they're trying to consider Airbnb versus just long-term renters, like what goes into that decision making process?
I would say so. The short-term rentals, the Airbnbs, it's active investing. In fact, the IRS classifies it as active, and that's why you get more tax write-offs, because it's active investing. Long-term rentals are passive. because you've got a property manager that puts in the work for you. So I would advise anybody, I think of long-term rentals as investing with training wheels, especially if you do it my lazy investor way. Get your experience on doing the least amount of work possible, and also like learning how to get a loan, and working with lenders, and how to work with teams across the country, and letting everybody do all the work for you is a great way of learning how to invest for the first time. Buy a couple of these, buy one of these, buy two of these, buy three, long-term rentals. Then I would say, I would then tell people, yeah, maybe you might be ready for long-term rentals now. But really, a long-term rental, to me, the value in a long-term rental these days in the markets that I'm in and the markets that I see my clients in is either A, it's an asset, or a lifestyle asset where, like I have a property out in Palm Springs, major government not, well, local restrictions. I'm only allowed to book it out 37 stays a year. And actually, that was taken down to 27 stays, and all the short-term rentals fought it, and we got back to the 37 stays. So I actually can't rent it, even though I book it out those 37 stays. I wish I could do more because I can make so much more money. But my point is, I don't make money on the property. The property literally, I'm lucky if it breaks even every year, but I keep it. And the reason why I keep it is because I love the property. I use it. My family uses it. Our friends use it. And then if we can rent it out, and guess what? It pays for it. Every time somebody stays there, they're paying down the mortgage. I can justify that because somebody else is paying for it and I get to use it whenever I want. So I think short-term rentals can be really awesome in that sense. If you're somebody that's like, hey, I would love to own a vacation rental for myself and somebody else is paying the bill, that's pretty awesome. Now, the other reason why I think short-term rentals can be great is the tax write-offs. With the short-term rental loophole, I get insane write-offs with it because it's active investing. But the thing that a lot of people don't realize is that, I mean, I'm not going to go into it too far, but if you do a cost segregation study on it that everybody's talking about right now, that's a one-time thing. And you don't get to take that write-off again after you take that. So you're going to have, if you expect to get these insane write-offs for short-term rentals in, forever, you're going to have to buy a rental every single year. And so maybe somebody wants to do that. But I will say that with my short-term rentals, I am attached to my phone. I cannot go out to dinner without my phone. I cannot go to bed at an early hour without my phone. And it's not because I don't have automation set up. I have all the automation set up. There's always something there. When I have so many rentals, I have 5 of them. There's always something that somebody needs something. There's a question, something broke, AC's not working. There's always something. There's always something to fix. There's always something to replace. And I'm the one dealing with it. So it is active investing.
Yep. Yep. Nope. It is, especially if you're going to be your own property manager in those. But it's worth it. The tax benefits, the depreciation, everything you get. I mean, it's a game changer, especially if you have a spouse that has a W-2 income that gets taxed and you're married, and you can combine that with the depreciation as a full-time real estate investor, and combine that depreciation to offset what they make in their W-2. Absolute game changer. That's what me and my wife do.
Yep.
She gets a big fat refund check back every year on all the taxes she pays, and she's like, "Wow, it's so great being married to you." I'm kidding. She doesn't say that in my head. That's what I hope she feels. Melissa, if people want to learn about you, learn more about the deal machine, how they can access some of these properties, where can they go?
Yeah, thank you so much. So you're going to go to passivelyrich.com. And I've got a couple different programs there. I've got the Deal Bank. Again, it's $1,000. It's lifetime access, and you can get access to everything that we talked about today, the off-market properties. Everything's already done, vetted out. Again, it's a pretty awesome program. People love to be in there. And then I also do have a mentorship program if anybody's interested in really kind of scaling and building out everything from, start to why real estate all the way up until actually building and scaling something. It's a pretty cool
So
program.
that's passively rich with rentals.com. Is that right?
That's correct.
All right, y'all go check it out. Melissa, it has been an absolute pleasure. Guys, if you know somebody that would get value from this, maybe they're considering getting an Airbnb or they're thinking about long term and they're wanting to go the turnkey route, maybe go check out Melissa's stuff. Go share this episode with them. Have them get in touch with Melissa, and we will see you guys next time.
Thank you so much.